long-term hard money lending. They're usually 30-year fixed loans. And their capital on how these lending institutions deploy this capital comes from different places. But they all end up doing the same thing at the end, which is they aggregate a bunch of loans, they package these loans up into 10, 20, 50, $100 million blocks, and then they sell them off. Okay, just like if you guys own your own personal house, name how many times a mortgage company has changed hands on your personal mortgage. So no one ends up holding the long-term paper. So they sell them off. But why do investors do it? Well, let's look at some of the pros and cons of each program. So debt service coverage ratio lending, DSCR lending. Okay, so what it is, it's a way for investors to buy as many real estate properties as they want without having to show DTI requirements and principal, interest, taxes, and insurance requirements for each property that they currently own. So you may wonder, like you'll go to these real estate events, and you'll say, how did this investor buy 20 rentals this year? This is how they did it. Okay. So for debt service coverage ratio, how every aggregator of these loans basically works, depending on if you do it with jet lending or another shop down the road or whatever you do, one of the national people. It's based off of really three categories. One is the debt service coverage ratio, and what that is it's a percentage of the mortgage and the rent. Okay, so let's look at your mortgage. It's your principal, your interest, your taxes, your insurance, and any association dues. The association dues you got to really watch for in condos because they're pretty high, but those things right there is a mortgage. Let's say those five things made, the mortgage $1,000 a month. Okay, for simple math purposes. The DSCR requirements could be 1.0, 1.1, 1.2, 1.3%, depending on what kind of terms you're looking for. So what you do is you divide the current or projected rent, divide that by the mortgage. So if the rent or the DSCR needed to be 1.2, it means the rent for that same property would have to be $1,200 a month if the mortgage was $1,000, because that would be a 1.2% ratio. Okay, so that's one thing that you have to contend to when you use DSCR lending, is that the property stabilizes itself. Okay, plus profit. Okay. The second thing is for DSCR is usually credit score minimum, usually at a 660 minimum. Okay. I've seen them range from 640 to 680. So let's call it 660, depending on capital lines that you're using. And the next thing is seasoning requirements. So a lot of times on these lines, you may not have any seasoning requirements, or you may have where you have to own it for 3 to 6 months, especially on a cash out. Because cash outs are inherently riskier for the lender. So they want to see that you own the property. So you'll have some seasoning requirements. Other than that, it's a pretty simple process of getting your applications in and things like that. Where it differentiates from conventional lending this is how conventional lending is structured. Conventional lending is based off your debt to income ratio. Now, conventional lending, you're allowed 10 conventional lending properties, including your homestead. So if you have your own property, you have 9 rentals that you can do on conventional sides. Conventional tends to be somewhat cheaper rates. It used to be a lot cheaper before prime was at 8.5. But it's still a somewhat cheaper rate. It's a little bit more arduous process because they dive into all your bank statements. They want all the monies to be seasoned. And the more important part that makes it difficult, doesn't mean you shouldn't do it, but you have to be aware of what you're trying to do and how you're trying to structure your business, is you need to show the PITI, principal, interest, taxes, and insurance, for each property that you have a loan with, plus the one you're trying to purchase or refinance. Okay, so you have to have a lot of money stored away in your accounts to show that you can handle the debt if you're going into the conventional route. All right, so this is one of the reasons why investors, especially that are people who are buying volume, tend to move towards the DSCR range. Though the interest rates are higher, they have more freedom to do more properties. Now, it doesn't mean it doesn't hold inherent irritations that come with it, because you'll have a lot of lenders that will tell you that, well, it's like a low doc, it's almost like a no doc loan or a low doc loan, and that's very true. You're not having to show a lot of documents and you send it over. What tends to happen is that you trade that ease of business for conditions. What does that mean? Well, it goes into underwriting, and there's always these conditions that come out that has to be cured. So if you end up going into a DSCR type loan, understand that it is a marathon. It is a team effort. So you send all your stuff in, you get your rate terms, you order your appraisal comes back. Underwriting will not confirm and lock your rates until a full package is done. Just like, even when you do conventional, if that full package has to be done and approved, your rates can fluctuate. But that's when you have more conditions come out, because again, these the funders of debt service coverage ratio loans come from different capital. They come from securities or insurance companies or pension funds and things like that. So as their markets shift and their requirements shift for their investors, they may add on requirements. They may take requirements away. So just know that when you're working with a lender and you do decide to go to the DSCR route, know that you just get a team behind you that can help you solve problems as it comes in. It is worth the time when you do it, but just know that you trade that 60-day close for a lower day close with a little bit of help with the team, because you'll have to say, well, I need to show this, or I need to show that, or I need to cure this item for conditions. So inherently, that's why people use debt service coverage ratio loans. It's a way to really scale your business. It's a way to incorporate more portfolio loans. You can do portfolios. You can do one-offs. They're not great for rural areas. I'll tell you that right now. So if you're a rural buyer, most likely you should be going back to your conventionals or your credit unions or your regional banks in that area. They'll know how to assess your property better. So that is it. I hope this helped. I hope it defined a little bit of why people are moving that direction in the industry, why people are using more debt service coverage ratio loans for their investments. Like I always say in our videos, if you have any questions or you want us to make a video on something that's just eating at your brain, let us know, and we'll definitely get that information out to you so you can be better prepared in this market and in any market to pivot, change your business strategies, and make more money. So again, this is Alex over at Jet Lending. Hoping you guys are having a great day. Hoping this has helped. We'll talk again.